I want to talk about the emergency fund because it is something that people keep asking online about. They want to know how much to have in an emergency fund. What's a good recommended number of months, amount of money?
Such a great question. And so literally, what is the difference between a rainy day fund and an emergency fund? In most situations, those terms are used synonymously. In reality, they are actually a bit different, and there are some key differences. So since you asked about emergency funds, we might as well just address both of them. The thing to think about when it comes to your rainy day fund versus your emergency fund is really twofold. So on the left side of this, we see rainy day fund, right? It's for those little uh-ohs, and it's a smaller amount. Typically, and everybody's financial situation is different, right? We have people making $30,000 a year up to people making $700,000, $1 million a year. But in a rainy day fund, since it's for those little uh-ohs, it's not for the catastrophic things. It's like for if your bill's a little bit higher, or maybe you need to take the dog into the vet, or small car repairs, right? Like my car's in the shop right now because somebody ran into me in a parking lot. Like those types of pieces where, again, not catastrophic, but you want to have some money set aside because you're not necessarily budgeting for it on a month-to-month basis. Typically, we see that in the $500 to $5,000 range. Again, very dependent on your financial situation, because if you're only making $30,000 a year, having $5,000 set aside is going to be probably a pretty tall task. But starting with at least some money, ideally getting to 500, is a big win. And even somebody like Dave Ramsey will really start to talk about the power of even just having a smaller bucket of money set aside that you don't touch unless you absolutely need to. So that's rainy day fund. Really, it sounds like for those rainy days, for the unexpected smaller pieces. Then you've got emergency funds, and that's for the more catastrophic, true emergency type situations. Like you lose your job or your income, or you need to get a new car, or something happens to your home and you need to replace the roof, right? Like those aren't little uh-ohs. Those can be some big things. In an ideal world, you really want to get to 3 to 6 months of expenses. So like your fixed expenses, right? Not shopping and things like that, not the ancillaries, but like truly the things that you need to pay for each month. And again, that can sound insanely daunting, but that's part of the power of something like Sequence, where you start little by little, right? You don't need to instantly get to 6 months. It's going to take you time, but by getting started now and setting up that rule for $100 a pay, $200 a pay, $300, all of a sudden that continues to grow, but also the amount of anxiety and stress that you have it's pretty shocking how much it can make you feel better, because so many Americans and so many people throughout the world live paycheck to paycheck. This is that way that you can start to like get away from that paycheck to paycheck mentality by just creating that little bit of a insurance policy for yourself through these separate funds. So rainy day fund, little uh-ohs, right? 500, 5,000. Emergency fund, take a look at like mortgage, car payments, insurances, all of the core things that you need to pay for. And in an ideal world, 3 to 6 months. We'll even have some people upwards of a year or more of all their expenses. Obviously, those are more extreme cases, or they've got great cash flow, so they can start setting that aside. But having certainly a couple months is a great goal to get to, and you don't need to get there right away. Like it's most important thing is starting that savings process so that you have that money and can continue to get closer to your goal.